for joining the Clean Intuition podcast, where my intention is to share my stream of consciousness with you on any given day. Today, I want to talk about what might be a bit of a hot topic right now, which is mortgages. And what I want to do is kind of go through a brief history of how mortgages have come to be in the United States and then give my opinions on some of the current news that's going on about it. I only have a finite amount of time, so it's not going to be a comprehensive history. I'm just going to go through a couple points that I have looked up over time, and then I compile it into a little bit of list that I'm going to be, some of it I'll be reading off to you. So, and then at the end, again, I'll get to why I'm bringing it up right now and why I want it to be an episode of the podcast. So, basically, the history of mortgages in the U.S. Have been kind of an up and down type of thing. At the beginning, there were more of a short term thing for citizens, and there was a lot of risk associated with it because um, the structure of the systems were not in place back then like they are now, especially before I would say like the 1920s and 1930s, and it was a lot of it was unregulated back then as well. So that's another thing that kind of whether or not things are regulated or not, you'll see that throughout the history as different rules and regulations have come to be, how it has shaped the way that mortgages are applied for, taken out, and structured basically. So um, before the 1930s or so, as I said, most of the mortgages were short term. In my research, I found that they were between 5 and 10 years generally, and most of them required a really large down payment, up to 50% of the loan amount, and then you would have, like I said, 5 to 10 years to pay it back, and most of that was interest payments, and then you would make a balloon payment at the end for whatever the principal balance was, unless you were able to refinance the remaining balance. We still have some balloon type loans like that. Most of them are not 5 or 10 years. They're usually stretched out a little bit further. But those still do exist, even though, again, the regulations behind them have changed a little bit. Now, that was before like the 1930s, the 1920s. So this is kind of like leading up to the time of the Great Depression, around that area, kind of after, before and after World War One, but definitely before World War Two, because obviously that's when the Great Depression happened. So after the Great Depression, we kind of went into the 1930s and into the 40s, which is World War Two time era. There were a couple different types of items that came to be. One of them was centered around the homeowners loan corporation and all of those people that ended up defaulting during the Great Depression and those loans that were in existence before then. Um, that entity came along to basically refinance the mortgages that people were defaulting on. What they refinanced them into was still kind of a short term type of product, which ended up being around, I believe it was 15 years. And the difference is that these had fixed rates, and also they had a setup where there was principal and interest, meaning that each payment would go, a portion of it would go towards the principal, and a portion would go towards the interest, and then there would be a scale where pretty much every month the amount of principal you paid would increase as the um, amount of interest kind of decreased. So it was kind of like I don't want to say scale. I guess it was like an amortization setup that they had. So that kind of helped people a little bit, in my opinion. Again, these are my opinions based on some of the information I've dug up. Because now you weren't just paying interest, and then you're required to pay principal at the end. And if you didn't have a job, you can't pay the rest. Now your responsibility is lessened at the end, so that probably helped a lot of people. So after that, going a little bit further, but still before World War II, the FHA came about, and this was more to ensure the mortgage companies as opposed to the borrowers, um, to in case of default. So even though it was to insure them, it did help the homeowners as or the borrowers as well, because they would end up setting up um, a system where they could insure relatively lower payments as well as different loan terms, longer. Like I said before, the previous section it was only 15 years, and then before that it was either 5 to 10 years. So you could have better payments, longer, a longer, slightly longer duration, and a lot of more people were able to buy houses. So, which is a good thing, because you want people to be able to purchase homes and live and all that kind of stuff. Shortly after that, in 1938, I saw that Fannie Mae came about, and now there was a secondary market for mortgages because obviously at that time there were a limited number of choices for people. You had FHA and then some, I guess, I don't know if at that time they were considered conventional loans or what. And this is obviously before the VA came about, and I'll get to that in a second as well. But it provided a secondary market, which also opened up some mortgage companies the ability to provide more capital for lending to take place. So basically, it made it possible for more uh, borrowers to, or more people to become homeowners and take out loans. And because that money was going back into the mortgage companies, it also gave them more funds to base loans on, if that makes sense. It all comes down to the money, of course. So in 1944, after World War II, shortly after World War II was ending, VA loans became a thing with the GI Bill, and those were low interest and low to zero down payment. Well, I guess it was zero down payment loans for the veterans that were returning home. So now the veterans that are returning home are able to, buy houses if they didn't have them already. And some of the research I did said that ended up resulting in more not urbanized areas, but more suburban, I guess, areas popping up because people were buying houses, out on the outskirts of towns and the surrounding areas and stuff like that. So, I guess that was good. Even though at the time we know that some people were and were not able to actually access those loans, but that's a discussion for another podcast. So, um, after that, there was a bit of a boom for houses, and I think that was during the baby boom era. I don't know what the actual years are for baby boomers or okay boomer or whatever, but I feel like during the baby boom era, there was another increase in people purchasing homes and home ownership in general. Because obviously, if there's a baby boom, you gotta be able to house the kids that result from the boom of the babies. Um, so that was, let's see, the VA was shortly after World War II. So this was going into the 50s, and it stretched for a while because again, baby boomers were around for a while, and also we know now that people call this the greatest generation. I think they call it. I mean, it was basically World War II and on. Um, so again, that resulted in suburbs and all that kind of stuff. And then after that, we saw another market expansion going all the way into the 80s. And at that time too, the instead of just the 15 and going back to the 5 and 10 year loan terms, that's when the 30-year loan term became the standard. I don't know how they came up with 30 years. I didn't, I mean, like I said, I just did brief research, so I didn't get that deep into it. Maybe maybe that coincides with the number of years people were working until they retired at the time, or I don't know. But for whatever reason, 30 years became the standard, and I know a lot of companies still offer those shorter terms, 15 to 20 years, and I don't know if I've heard of 5 years for anything other than the car, at least not recently. So um, around that time, we also had other entities arise like Fannie Mae, Ginnie Mae. I'm sorry, not Fannie Mae, Ginnie Mae, Freddie Mac, and then there were a couple of others that arose, and all of these were basically to guarantee the backing of mortgages and further insure the companies against default, but also to help the borrowers out by making more products available to them. Um, and you could argue whether or not those were good or bad for people. Um, the only thing I know is it made it possible for more people to actually take out loans and own homes, assuming that they had, they were employed the whole time and could pay their mortgages. So, anyways, that was just a short little synopsis. I got a little bit more after the break, and then I'll get into also why I wanted to bring this up in the first place. So, again, thanks for joining, and we'll be right back. With the King Intuition. With the King Intuition. Okay, thank you for coming back, and we appreciate you viewing. The last two things that I spoke about before the break was Jenny May and Freddie Mac as they came about. And Jenny May was 1968, Freddie Mac was 1970, and again, those were basically built to secure um, loans, the funding for loans, and then provide additional markets to or additional options for borrowers to apply for and secure in order to uh, have mortgages and purchase homes and things of that nature. So after that, we saw a bit of a shift going into the 80s and into the 90s. Um, and it was kind of in reaction to a period, I want to say in the 70s, where inflation levels spiked, kind of like they are doing today. Um, in reaction to that, they came up with a new, well, I don't know if it was new at the time, but something that was more widespread at the time, which is adjustable rate mortgages. So your rate would fluctuate based on the markets, and you wouldn't be locked into an initial high rate. That was the idea. Plus, a lot of them would start you out at the what they call the floor, which is the lowest rate possible under that product, and then you would kind of move forward after that. And again, you were kind of it was subject to where the market went. So this month it could be, I don't know, 5.4%. Next month it could be 5.8%, or it could go down to 4, unless your floor is the bottom rate is at that level. And then I believe some of them had a ceiling as well. So it depended on the type of product that you actually had, but those were some of the options that you would see with those products. And again, this provided more options for people to be able to apply for and purchase homes and have loans that go along with them. Um, and of course, when that happened, there was a reaction to that as well because, again, some of them had a ceiling. The ceiling would be the highest amount you could go to. There were ceilings as high as 16, 17% at the time. I might be off slightly by a couple points, but I feel like I remember hearing the number 16 in there. Um, 16% is a really high amount to pay for a mortgage. I mean, I know people have credit cards that are like, 23% APR or whatever, but 16%, um, that's pretty high. So, and those numbers I believe came in the 1980 range, maybe 1981. And let me look at some of my other. Um, oh yes, and the introductory rate is what I was talking about a second ago for the ARM, where they'll start you out with a slow rate and then it'll kind of progress from there. So again, reaction, action, reaction. One of the things that happened in reaction to that, which is not a good reaction, happened in the going up into the 2000s. See, this was in again the 70s, 80s, and into the 90s that these other loan products were being created and offered. So the problem with that is people would take out a loan at the introductory rate and base their life on that introductory rate. if you have an adjustable rate mortgage, it's not going to stay at that introductory rate. I mean, that's just a fact because the rates are going to, it's guaranteed that the rates will fluctuate. So you're never going to stay at that introductory rate. Plus, some uh, lenders were under, and what's the opposite of inflation? We're deflating the rates at the beginning to get people in. And I don't know, I'm not going to say my age. This is going back a couple inside joke from a couple episodes ago. But when the internet became a thing and you would go on sites like, I don't know, Google or whatever was there before Google, Ask Jeeves, I don't remember all the sites back then, but they used to have these banner ads on the sites that you go to. It's just like ads you see today, but they were banners, and it would be like $800,000 loan for $200 a month or something like that. Usually, if you click on that ad, it would take you to a page that was offering you an adjustable rate mortgage with a very, very low introductory rate and usually a low down payment to go along with it. So it would be, uh, $5,000 down and $200 a month for an $800,000 loan. Of course, I'm exaggerating, but you would see something like that. Maybe it was 400 instead of 800,000, but of course the fine print in that is this is the introductory rate. Be prepared to pay more, 3 months from now when the rate changes. But people were taking out loans based on that introductory rate, and again, basing their entire rest of their life on that introductory rate. And again, we all know it's not going to stay at that amount. Like the rates are going to change regardless. So uh, that led to the next period, which is in the mid to late 2000s, where the housing crisis happened. All them people that were signing up for the loans, um, Bank of America, Countrywide, Wells Fargo, Wachovia at the time, Chase, City, like all these other banks. I said Bank of America already, but all these banks, even some of the local banks in whatever area you're in, were offering these loans and basically pushing people into them because loan officers and all the other people involved downstream, the servicing people, they were making a killing getting these loans pushed through. And I know for certain, I wasn't a loan officer, but I actually worked at a mortgage company. I won't say which one, but I worked at a mortgage company and I was in customer service for a period of time at that mortgage company. And regardless of why the people were calling in, we had to upsell one of these subprime loans to them, an adjustable rate mortgage, a line of credit, which got a lot of people in trouble, whatever the other products were at the time. We were required to upsell that during the call. So these people could be calling in, mad because they got a late payment or, they can't get away from the prepayment penalty, which was a thing on loans as well. Basically, prepayment penalties were you agree to hold the loan for at least X number of years, or there's a penalty involved. Because if you don't hold it for X number of years, that means you're not paying that X amount of interest to the mortgage company. So they need to make that money somehow. So they're going to charge you a penalty if you pay it off within, say the term is 5 years and you win the lottery and want to pay it off in a year, or move to you bought a mansion, now you want to pay off that house or whatever. Now you got to pay a $20,000 penalty. I'm pulling numbers out the air, but they need to make that whatever they were expecting to earn in interest. They still need that money on their books. So they've written that into your loan and your house note. But again, because a lot of these loan officers were pushing through these loans, some borrowers ended up glossing over that part. Whether you want to blame the borrower for not knowing as much or the loan officer for not presenting the information, or maybe it was there and they just didn't understand it, or whatever the case, it was happening. I know because like I said, I worked there and we got a lot of calls for that. So anyways, I'm getting off track. Prepayment penalties, and it's all about interest and it's all about money. Like I said at the beginning, follow the money. It's all about the money. So That ended up leading to the crisis that was in happened in 2008, and that was after a boom happened because of all these crazy products that were available to people. So you got more people buying homes, and half to the majority of them, more than half of them, couldn't actually afford the homes when it came down to it. You can afford the introductory rate. You can afford the rate that you had when you first took out the loan, especially for adjustable rate mortgages or for the other subprime products. They would get you in at a certain thing and then at a certain set of circumstances, and then after a while, the loan would convert into something else. You could afford it at the beginning, but 2 years later, you're upside down on everything because the payment has risen, has doubled for some people, and you just can't pay that. Uh, Partner that with the fact that a lot of people were getting starting to get laid off for whatever reason in different industries, and they just couldn't, they just couldn't pay the mortgage anymore. So that led to a crisis because people were getting foreclosed on and all kinds of things were happening. And so some of these companies tried to present even more complex versions of products that they would make available, and that didn't help situations because again, if you take out a loan and you're whether no matter what they're saying to you about what the rates will do, in your mind you're paying $1,500 a month or whatever, but then when that bill comes for $2,800 a month, what recourse do you have at that point? And you don't have $2,800, you have $1,500. So people were getting foreclosed on, people were defaulting. A lot of these companies didn't want to modify the loan because no, you signed that. No, go on now. You signed that. You signed it. You was there. You was at the table, kind of thing, and really taking no accountability for some of the malicious practices that were going on at the time. And again, me being in customer service for a while, I saw a lot of it. So I wish that I could say the company and give you more information, but I'm not trying to. All of that stuff has been litigated, and you know, I wasn't a part of any of the litigation. So don't start. I mean, Google Keen Intuition show, but don't Google Keen Intuition involvement in the subprime, all that, whatever. Don't do that. So, um, needless to say, people were in trouble, and there were areas where more people than not ended up being in trouble. Obviously, in urban areas and in some of the suburbs, not the baby boom suburbs, but well, I guess it's all the same suburbs, but not the baby boomers necessarily, because a lot of them took out mortgages before that. But people who moved in as baby boomers either aged out or moved on or whatever the case is, people who ended up purchasing those houses are some of the ones that ended up in trouble as the crisis was happening. So again, action leads to reaction. So as the crisis was happening, and shortly after, um, sorry, we had a lot more regulations that came about, and the guidelines had to be tightened up because if you have somebody that has a, I don't know, 450 credit score and is only making $20 a week, not a week, $20 an hour, um, they're not going to be able to afford a that $800,000 house that I was talking about earlier. It's just not feasible unless they have like a down payment of $500,000 or whatever. And like at that point, why not just buy a $500,000 house and be done with it? But that's not how a lot of people were thinking back then because all this stuff was being flashed in their face. And again, banner ads back in the day, and then obviously the communication methods became a little more sophisticated. But that's that's what happened. I mean, it's on record. It's on record. You probably know somebody that got foreclosed on. I mean, I probably do. I don't know. I don't be getting in people's business like that, but I probably do know some people. But that's what happened. Again, action and reaction. So after that, the industry kind of, like I said, started to regulate, deregulated, and there was some self-regulating, which again helped because it stopped some of the outlandish stuff that was going on. You know, no more banner ads. I mean, of course, you're always going to be ads everywhere, but the ads wouldn't lead you to something that you know these people could not afford, at least in theory. So that brought us all the way up to through the 2010s and up into going towards 2020. Of course, we know what happened going into 2020. Uh, COVID-19 happened. So that was a whole nother thing. And we still, like, it's 2025 as I speak. And the effects of COVID-19 have not diminished, in my opinion, because at that time it seemed like home prices inflated um, quite artificially because you could have had bought a house for I don't know $150,000. As COVID kicked up, now that same house is like $310,000. It's the same house, same area. You know, they didn't put diamond. The windows are not made of diamond. You know, they didn't put titanium. You know, the fence ain't made of titanium. You know, all that kind of stuff. But they, for whatever reason, the prices started inflating. Well, I mean, obviously it was because of COVID related items. I don't even know really what the mechanism was behind that because it's not like the supply chain affected homes that were already there. Like new homes, yes, I could see that because I think the cost of lumber went up, the cost of steel was fluctuating. Obviously, gas prices were fluctuating and things like that. But um, yeah, I don't know. I don't know. But again, action, reaction. One of the things that started happening during that time was the Fed started messing with the interest rates. And if you listen to one of my last episodes, I talked about how the current president wanted them to adjust uh, interest rates to encourage more spending, and which they ended up doing. They didn't want to do at first, but they ended up adjusting, I think, by like 0.25% to encourage spending. Did it really encourage spending? I have doubts because people that were on the fringes, maybe, who were thinking about purchasing a house or purchasing a car or whatever the other expenditure is, like it was more of a necessity for them other than a desire. Maybe they were pushed over the edge because, you know, you're going to see a slight difference because of the interest or whatever. But the masses of people were still looking at them prices and thinking, yeah, this is too much. Like this car is too much, and this house is too much, and this boat is too much, or whatever the other cases are. But anyways, regardless of that, again, I'll subject again, and I apologize, but my voice is going crazy. I think I'm catching a cold, so you'll hear that all through. But the mortgage rates ended up dropping at that time, and after previously rising due to inflation. And in addition to that, mortgage companies were finding ways to lessen their overhead and the cost to actually write mortgages uh, because of things like digital platforms and AI starting to come in to the picture, and the automation of the all of I mean just automate overall automation. So if there was a situation where you had to go in and actually see somebody and sign 15 documents or whatever, now you could use something like DocuSign or Adobe or something like that and sign it all virtually. And again, I have personal experience with that because I'm not going to say how many years ago, but after this stuff started happening, I was able to purchase a house, and most of what I did, other than the actual last closing of it, was virtual. So I literally had uh, my Android phone, and maybe we'll get into iPhone versus Android at some point. I'm an Android person, and I've had both, so I know what I'm talking about. Anyways, I had my Android phone with a pen, And literally, they would send me the document, and I would go into my phone, and I would literally do my signature and send it back, and it was all on secure sites and stuff. So that was probably 90% of the documents. But then I had to actually go in person to do the last signing part, which was a stack of papers like a foot high or whatever. But regardless, all the stuff leading up to that was done virtually. I didn't have to go see nobody in person. That's cutting down on them paying people. And it's just like how when instant tellers became a thing, or not instant tellers, but ATM machines became a thing. Now the instant teller person became less necessary. Like some of them are still there, but you don't see as many of them in banks. Or if you go to grocery stores, I think even Publix has this now. I'm in Georgia, so Publix, Kroger, Walmart, uh, stores like that, Food Lion, whatever. Like they have the self checkout now. It's the same type of thing. It's taken away from them having to pay people and putting the onus on you to actually go through the process. The same with some fast food places. They've been doing automation. Like some people were blaming it on them trying to raise the minimum wage or whatever, which that probably has something to do with it. But they've been they instituted touchscreens way before anybody talked about raising minimum wages, where you just go in, you don't even talk to nobody, you punch in your stuff, you pay right there, and the only thing that happens is at the end, after your food is ready or your order is ready, somebody might hand it to you. But I went to again, getting off topic, but all of this is somewhat relative. But I went to a football game not too long ago to see the Falcons play. They have restaurants all throughout the stadium, but there's this one in particular that I happened across, and I don't know if there are multiple like that in there, but literally you swipe your card to get into like the area where the food is. There's a wall of like a conveyor belt type thing that has a bunch of options that you have, whether it be, I don't know, hot dogs, French fries, burgers, chicken fingers, whatever else, cups for drinks, and you literally take what you want, and they have your card on file, and the little person is over there monitoring everybody. Take what you want, walk out, and then your card ends up getting charged. You don't have to talk to nobody. Nobody's actually serving you. I mean, there's people back there cooking the food, but like those extra, I don't know, 5 people that would have been working the counter, now they're obsolete because that's the setup. Relating it back to this discussion, that's how some of these loans are being written now, and that's helping these companies to reduce their cost. Um, as a result, some of the costs behind that ended up decreasing for them. So they're making more money, and again, it's all about the money. Follow the money. So I know I don't know how long this podcast is going to be. Probably 45 minutes. But the whole reason I brought that up is because your boy done introduced something else entirely. The current president. Um, as I said before, the standard is 30 years. Now I've seen 15 years. I haven't seen so many 10 or 5 or 10 years. I guess that probably does exist on like if you buy a speedboat or something, but or a yacht or something like that. But 30 years is the standard. They're talking about introducing a 50-year mortgage. Why would you do that? Instead of working on everything that's leading to the inflation that we have right now and the state of affairs that we're in right now. All you're doing is ensuring that people stay in debt for a longer period of time. Nobody's ever going to pay off a 50-year mortgage. You would have to buy a house at 20 years old and you, uh, assuming that nothing else comes up, you'll be 70 when you pay it off. 70 when you pay it off. 70. 70 years old when you pay your house off. I think the Social Security age right now is, I want to say 60. I think you start at 63 to get the lower benefit. Then it increases up to 65, and then I think you get the full benefit at 67. So again, I could be off a year or two, but that would mean that you would be well into your Medicare and Social Security age, and you would still be owing a house note. What sense does that make? Is this supposed to entice people into buying these overpriced houses or whatever? Because your payment's going to, they said, I saw a report where it said if you uh, purchase a $400,000 house, you would be saving between $200 and $300 a month. I'm not gonna lie, saving $200 or $300 a month would be a good thing. Anybody wants to do that, but not if you stretch out your requirement for 20 extra years, and then over that 20-year period, you're almost paying double the amount of interest. So all you're doing is making the mortgage company richer and keeping yourself in debt. And this is on top of, groceries, insurance, gas. You want to watch TV sometimes. You need internet so you can watch my podcast, whatever. Like, you need internet so you can watch my podcast. You need internet so you can watch my podcast. Anyways, all these other things in life. You have kids. They're in sports. Somebody chip their tooth. They need braces. They need, like, all the other stuff. So you're extending out your liability and not getting any more value for it. Like, literally no more value. It's the same house. It's the same house. It just, I don't know, but all I know is you need internet so you can watch my podcast. Anyways, this is something that they are floating into the atmosphere. And it just, like I said, it got me thinking about the history of mortgages within this country in particular. And I don't know, I don't understand who came up with 50 years. I don't even know how they came up with 30 years. I said that before. It seems like it should be, in my opinion, it probably never should have gone above 25 years. And the interest rate should have been even lower. So that same 400, I probably should find some way to calculate this, but that same $400,000 mortgage would end up costing you even less in the long run. But again, it's about the money. Follow the money. These mortgage companies are trying to make more, not less, and that's pretty much the business plan for anybody, especially in a capitalist society. So I'm not going to say I don't understand that part of it, but why make things harder for folks? That's not making things any easier. $300 a month is not enticing enough to trade off 20 more years of your life in addition to double whatever the interest might have been. And that's assuming that you're a qualified buyer. We haven't even talked about your credit score and the down payment and like all that kind of stuff. We haven't even gotten into that part yet. We're just talking about on the surface, going from having a 30-year mortgage to having a 50-year mortgage. The next thing they're going to do, they're going to end up, I just said Social Security, I believe, starts at 63 and then goes up from there. They about to raise it to 75, 80 after that, because they know people ain't going to be, like, you're going to have to work until after you die. And then what happens when, like if you pass away at, you buy a house at 30, you pass away at 65, somebody got to satisfy that debt. It's going to get handed down. This ain't building generational wealth. This is shackling generation. It's generationally shackling. I'm probably not. Y'all know what I'm saying. It's generational burden, I guess, is a better way to put it. Y'all are going to make them people's kids, and probably them people's kids, because all of y'all gonna have to live in the same house forever. You can't move nowhere else because they gonna get another 50-year mortgage. Yeah, they'll have the option of getting a 30-year mortgage or whatever the other products are, but that's if they can get from underneath your debt. And because most people, not most people, a lot of people are not able to generate savings like they need to, and because there's no such thing as uh, when the companies used to offer retirement, it's all based on like 401ks and all of that kind of stuff, and those, everything that the stocks and the 401k, the factors that go into the 401ks are fluctuating just like the interest rates are, and well, everything but inflation. Inflation is just going up; it's not fluctuating. The only thing that has uh, gone up and down a little bit is gas prices. And the last time I got gas, I think it was down like, I want to say 15, 20 cent or something like that, which is not bad, but it's not good. And again, in one of my last episodes, I mentioned that when I first moved to Georgia back in '97, gas was 69 cents a gallon, and it's not 69 cents a gallon no more. It's at least four times that, in the neighborhood of three and a half to four times that at this point. Um, the gas don't have gold dust in it. The gas, well, anyways, I've already went through that. So basically, you're straddling these people with debt, and that makes zero sense to me. But then again, when I go back through the history of how mortgages came about, it's always been about enriching the mortgage companies and, oh, you might get a house out of it kind of thing. I mean, I'm simplifying it, but that's what it seems like is happening until the regulation came in, until all these other products became available, until all these government entities, Ginnie Mae, FHA, came into it, until somebody ended up stopping the crisis by having to redirect all these unscrupulous companies from handing out stuff to people they knew couldn't pay it back. And what do they do now? On top of that, create a product that nobody's gonna pay back. Nobody's gonna pay back a 50-year mortgage. You know it. Now, I guess you could say, somebody could take out a 50-year mortgage trying to take advantage of the lower payment, and then, sorry, and then hopefully at some point their job situation will improve, or maybe they'll hit a lick, as we say, and come into some money, maybe win, I don't know, $50,000 in the lottery or something like that. You'll be able to pay that down, or you'll be able to refinance into a more favorable situation, um, or you'll be able to pay down the 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 principal, and so your interest level will end up decreasing based on that. Yeah, those are all possible, but none of those are guaranteed. So it's just like when people were taking out a line of credit or whatever during the crisis, and people were either taking those out and buying cars, or doing home improvements, or whatever the case is, to finance medical bills or whatever it is, with the intent that at some point they would refinance their main loan and their line of credit into a new loan. But then when that time came, they had been laid off, or the 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 job their salary didn't increase with inflation, so now they're paying more for just daily stuff and didn't get to save up enough to go towards that plan or whatever. Like, I guess at the end of the day, I'm saying that having a plan is good, but none of that stuff is guaranteed. So, and that's the case with anything, not just with this topic. So, yeah, like I said, that was the reason I wanted to bring this up. And I mean, when I saw them reporting on that, it piqued my interest because it just sounded crazy. But of course, since I did have history working with the mortgage company, at a mortgage company, I should say, I wasn't a loan officer or nothing, but I did work at a mortgage company for several years, part of which I was in customer service and seeing them push the craziness. It made me want to kind of look back through history and put that together with what I already know, and then bring y'all a wonderful show. And if I didn't mention before, you need the internet so you can watch my podcast. No, I'm just playing. Again, I don't really know where else to go with that. Maybe I'll have another episode about this if they have any other updates on what they end up landing on and what ends up being offered and what the details are, what the stipulations are, and all that kind of stuff. But obviously, that remains to be seen. I really, really hope they don't actually make that a thing, unless something else comes along with that, some kind of guarantee or like some kind of stipulation gets in, you know, included in that will further guard against these people being in distress financially. Like that's the only thing I can think of. I don't know what shape that will take, but I'm just saying I hope if they go in that direction, that's what will end up happening. So, anyways, I guess that's kind of all I have for today, and yeah, I'll end it right there. So, in closing, I'd like to say thanks again for joining the Keen Intuition Show. Thanks for your support now and for any that you give in the future. And one thing I always say is if you didn't hear it directly from me, then there's a good chance that I probably didn't actually say it. On that note, see you next time.